Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya in for Andrew Bell this week. And so now let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. U.S. President Donald Trump is calling for a de-escalation after Iranian and Israeli strikes hit major energy sites across the Middle East. An attack on Qatar's Ras Laffan gas hub caused significant damage, while Israel struck Iran's key South Pars field. Trump says the U.S. was not involved in the Israeli strike and warned Iran against further attacks on regional energy infrastructure. Shares of Micron Technology are falling in the pre-market today. The tech company revealed plans to boost capital spending, which drew concerns among investors. Still, Micron reported adjusted earnings well above estimates, with revenue of $23.9 billion US, also topping forecasts. Micron produces memory chips for NVIDIA and is benefiting from surging demand of NVIDIA's AI chips. AutoCanada swung to a fourth quarter loss on lower revenue. The Edmonton-based multi-location North American automobile dealership group says its fourth quarter performance was shaped by a more challenging market backdrop. Demand was affected by activity like the sunset of Canadian EV tax credits, which benefited the fourth quarter of 2024, and tariff-related policy changes that drove stronger demand in the first half. We'll take a look at U.S. futures today, all trading down at the moment. The Dow, the Nasdaq all down, and the S&P 500 down almost a full percentage point to start the day. This, of course, is investors weighing what's happening in the Middle East as the conflict continues there. Airstrikes ramping up, as we're telling you about. If we take a look at the TSX, an interesting day yesterday, losing more than 600 points yesterday, and we'll have to wait and see where the TSX stands during the opening bells, which is just about half an hour from now. North American markets appear poised to open lower, and oil and natural gas prices are surging after another round of attacks on Middle East energy facilities. Our next guest, though, says markets are proving more resilient than some would expect, given major geopolitical shocks. Joining us now is Christine Tan, portfolio manager at SLGI Asset Management. It's good to have you join us. Good morning.
Good morning, Lindsay. Thanks for having me.
Yeah, thanks for coming on. This is an interesting take. Where are you seeing the most resiliency in the markets right now?
It's more about, when we made that comment, it was more about the relative considered to what the headline risk has been. Markets have been quite resilient. You're seeing a little bit of rotation underneath the index level. And what you're also seeing is more differentiation between the different countries. So, for example, Asia and Europe, clearly much more impacted directly by actual supply disruption. So there are two parts of what's happening as a result of the Iran war. You've got prices going up, but then you actually have the physical disruption of supply impacting Asia and Europe. And I think what we're, sort of watching very closely is markets have actually been quite resilient, again, relative to the shock. And part of it is we believe right now the view is still perhaps this is a bit of a transitory or like we would see a bit of a resolution sooner rather than later. And there's also the thought that perhaps this stays a little bit more contained to more energy prices. What we are more sort of watching very closely for is if this does extend longer, and you just spoke about how we've seen some strikes on actual oil infrastructure, if this does get a bit more extended, you start seeing second-order effects. For example, we do get a lot of nitrogen-based fertilizer coming out of the region that's being disrupted by what's happening at the Strait of Hormuz as well. So these are not factors that are necessarily being priced in fully in our view, and that's kind of what we meant when we said markets look more resilient than given the geopolitical noise that we're seeing.
Okay, I take your point. Resilient given everything we're seeing geopolitically right now.
Exactly.
And I heard you when you said as well, if this becomes more of a long-term situation, what we're seeing in Iran and in the Middle East, things could change. What do you think the oil story is short-term, or do you think we could see long-term supply issues here?
If we were having this conversation 3 days ago, I would say that perhaps it is more of a short-term disruption. But given what's happened just in the last 24 hours with Israel hitting the natural gas field in Iran and Iran sort of responding by hitting some oil assets in some of its GCC neighbors, we are sort of starting to step into another phase of this conflict. So it is a little bit worrisome. It is something that we want to watch very closely, because what we've said sort of 3 days into the conflict is there were two scenarios that was kind of our base case, if you want to call it that. One, it was going to be very short strikes, basically remove capabilities, nuclear capabilities of Iran, and then you sort of start moving towards some sort of longer term agreement or truce. Second case, which is kind of where we've been for the last week and a half, is it's a much more extended conflict. But what we had identified at that point in time was a third, what we thought was a low probability outcome, is actual disruption of oil and gas infrastructure, which means that even after this conflict is resolved, you're going to see a permanent impact on oil and gas supply because infrastructure has been damaged. So that's probably what our concern is. In the short term, the market's still kind of focused a little bit on short-term disruption. Coming into this conflict, we were in oversupply in the market, in the global market, so that's why energy prices were quite contained and probably on the weaker side. But we are now moving into a different phase. So medium term, there is a real risk that infrastructure, if it is damaged, that we physically will have a little bit more of a permanent disruption of supply.
It's such a good point that even when this is all over, whenever that is, there's still going to be a lot of pieces to pick up, as you say, a lot of infrastructure damage so far. Is there anywhere that investors can go that you think is maybe like a safer bet right now in terms of sectors within the market?
So our message has been to not overly react to what's happening in the market. So we're kind of still sitting in the camp that we believe there is a resolution at this point. And you are seeing an escalation in terms of hitting infrastructure. But we still think most parties that are involved, and we heard overnight, President Trump has called for a de-escalation. So certainly the base case is there isn't a desire to necessarily really take it to a very extreme escalation. So based on that scenario, we have been speaking to clients about not overly de-risking, but really revisiting their portfolio and thinking more intentionally about their exposures. We've seen certain asset classes in certain regions do extremely well over the last 12 to 15 months, and maybe it's rebalancing away from some of that outperformance, but not de-risking in a meaningful way. I think what's more interesting is the traditional safe havens, if you will, which is fixed income. It's not really working the way it's intended because this is a inflation risk potentially, and what you've seen is the back end of the bond yield curve move up. We've also heard from the central banks, Bank of Canada, Fed Reserve. We're going to hear from ECB today. They've been quite cautious. They've actually been, no one's really made any significant moves in terms of interest rate decisions, and the view is it's watch and see mode at this point in time. I would say, if there is one tiny pocket of potentially resilience within, let's say, the U.S. market, it would be some of these tech names where they are less directly impacted by what's happening in the Middle East. But again, if we do see a more protracted conflict and if we do see energy prices stay higher for longer, we do know that AI, for example, requires a lot of energy as well. So it really depends on your sort of view of the time horizon of how quickly this resolves itself. But we are basically cautiously around the edges, kind of rebalancing the portfolio. We're not making any big shifts. On the positioning front, we've had a tactical position in gold for several quarters now. That was working for a little bit. In the last few days, it's been sort of pulling back a little bit more because of potentially stronger U.S. dollar, and maybe there's a reflection on what the growth prospect would look like for the world. We have a sort of a strategic overweight to commodity, the oil as well as a commodity, so that's been working well for the portfolio. But those are kind of some of the tilts that we had coming into this.
Right.
What we did do is reduce our EV exposure just a little bit, again, with the view that that is a part of the global index, a global market that's going to be much more affected by an extended disruption in the Strait of Hormuz.
Christine Tan,
but overall, keep calm and sort of stay diversified has been our main message.
Okay, we'll have to leave it there. Christine Tan, Portfolio Manager at SLGI Asset Management. Appreciate your time today and your insight. Thank you.
Thanks, Lindsay.
And for more on the damage to energy infrastructure in the Middle East and spiking energy prices, we sat down with Ian Bremner, President and founder of Eurasia Group, to get his take on the fallout.
President Trump doesn't really have a plan that's operational to open the strait to non-Iranian traffic in the foreseeable future. Absent that, they are escalating. He doesn't really have anyone to blame, and he doesn't have an off-ramp that's plausible. So that means more pain, more damage, and hopefully they find someone eventually they think they can work with. But they aren't there today. And you'll note when the Israelis hit Iran's oil capabilities outside of Tehran in the first days, the United States pushed back against that. They weren't happy. This time around, it was the Israelis that did the strikes by themselves, but they informed the Americans in advance. U.S. isn't criticizing. So, I mean, clearly the willingness of the United States to support broader strikes against Iranian energy infrastructure, knowing that it will lead to retaliation, is born from frustration and the fact that we're still not getting so much of this oil and other shipments out.
Allies, as you know, refused to get involved in policing the Strait of Hormuz, which is what Donald Trump was asking. Could that have been, do you think, an off-ramp for Trump if they had agreed to it?
It would have helped, because right now one of the carriers, and with a big fire that was on board, is having to be sent to the Mediterranean for repairs and for investigation. Also, in terms of the shipping and escorting the shipping, 3 of the literal ships that the United States had ready to participate are now going to have to go to Malaysia for repairs. That's going to be a minimum of 3 weeks, maybe much more than that. So the Americans are being delayed in their capacity to take care of this by themselves. They could use the help, even though Trump has said, as I'm sure you've seen, after the allies refused them, that he doesn't actually need their help and that the Americans can do it all by themselves. So Trump himself has been all over the map in terms of what the purpose of the war is meant to be, when the war will be over, whether or not the U.S. is engaged in a war of regime change or not, whether the allies are required. I mean, really, there's never been a foreign policy that Trump has pursued that he's been so inconsistent on in terms of his own messaging. And he's clearly unhappy about where it's going right now.
You said there's no clear off-ramp. Is there even a clear path to de-escalation?
Well, I mean, if I were advising Trump directly right now, I would tell him to stop and declare a win, which he would obviously do if he stopped, and then, work on the diplomatic engagement, not the U.S. directly, which won't be seen as credible here, but all of the other countries that really need the strait open, who aren't participating with the Americans militarily. The Indians have already had some success with the Iranian president. The Pakistanis have as well. Others could engage. That would be a path of de-escalation. But I don't see Trump taking it, because for him, that feels like a loss. He doesn't think he can sell it. He's not comfortable about where it is right now, because the Iranians are still able to take pot shots on Gulf infrastructure, including things like desalination plants, very dangerous in the region. They're also able to take drone shots and missile shots, and we've seen the numbers of drones and missiles launched by the Iranians over the last 10 days has been pretty consistent every single day. The drone numbers have gone up the last 3 days. So it's not as if the United States has done a lot to destroy conventional military capabilities, certainly their Navy, but that's not helping with the strait. So Trump does not feel like we're close to a de-escalation.
Okay.
Also, let's remember that there are 5,000 American troops that are heading to the Gulf, and they're not on a tourist mission. They are intended to be used. And so it does feel to me like we're going to see escalation in the coming weeks.
I was going to ask you then, does this feel like the beginning as opposed to an ending?
Well, not the beginning. I mean, the supreme leader's been assassinated, right? We're well past the beginning, but I don't think we're yet turning the corner on de-escalation, on looking at an end or negotiating for a ceasefire. I think that you've got the potential to actually occupy Karg Island. If you can't get rid of the regime, that would at least control the money that the regime would no longer be getting from selling all the oil that They are presently selling at $80 a barrel every day. They're sending more oil out of the Straits right now, the Iranians, than they were before the Americans attacked. So something is likely to be done on that front. You've got all of this enriched uranium stockpiles that would build, if used for weapons at a higher grade of enrichment, some 10 to 12 nuclear weapons. I suspect that the U.S. and the Israelis intend at some point commando raids to destroy or remove that enriched uranium. Then you also have a potentially, and this is dangerous, and this would be long term, but the potential of occupying some of the southern coast of Iran to prevent the Iranians from launching all of these drones at ships going through. All of these things are presently being considered by the president. The capacity to launch those ground forces will not be in place yet until those troops are in the Gulf. And we're still about a week and a half from that.
That was Ian Bremmer, president and founder of Eurasia Group. A new report shows Canadians have had it with tipping, and they think it's gotten out of control. We've got more details on that coming up right after the break. Welcome back. If you are booking a flight, you obviously have to be extremely careful that information is entered correctly, or it can lead to problems at the airport. A passenger noticed a minor mistake on his plane ticket, and he was told by the airline it shouldn't be a problem and was shocked when it was. CTV's Pat Foran has more in this report.
Brandon Bowman of Milton traveled to Thailand in January for almost 3 weeks and says the vacation was one of the best adventures of his life. But it came with some stress. In November, when he booked his tickets with Air Canada, he noticed there was a space missing between his last name, Bowman, and his middle name, Rodriguez.
My last name and my middle name were joined. I called them. Their employee said it should be fine.
The return ticket to Thailand cost him almost $5,000. 2 days before his flight, he thought he should check in to make sure everything was okay. That's when he got a different answer from a different person.
The next employee I got, the lady said that it's not fine. We have to cancel everything. And it jumped about $6,000 in price extra.
His name was corrected on the new ticket. He was flying business class, and on short notice, the new price required to board was now over $11,000. He felt he had to go through with the trip as he had planned it for months and prepaid for many tours and outings.
Because I couldn't cancel the flight, I booked the time off from work. I did flights within the country I was going to and excursions and hotels.
Bowman enjoyed his vacation, but when he got home, he felt he should be compensated since he did check with Air Canada if his ticket would be valid with the missing space. When CTV News reached out to the airline, it said passengers should always check the booking confirmation immediately after they purchase a ticket to be sure all information is correct, including the itinerary, travel dates, and name spellings. But Air Canada added, the customer should have been advised more clearly about his options during the initial call, which would have remedied this situation. So we have refunded the difference. Air Canada just returned over $6,000 to Bowman, which was great news for him.
Thank you, CTV, and thank you, Pat Foran, for being behind my back for this. I'm so happy I got the money back. Thank you so much.
Pat Foran, CTV News.
Up next, we've got to look at some of today's notable calls, including Micron. That's next. Stay with us. Raymond James raised the firm's price target on Micron to $530. That's up from $310, and is keeping an outperform rating on the shares. The company delivered monster upside on both the print and guidance, which met or exceeded more aggressive buy-side expectations. And the analyst tells investors All of that in a research note. And we're, of course, going to be watching Micron Technology shares today to see if they move any further. In other news, a survey released from H&R Block shows that Canadians have tip fatigue. In fact, Canadians are so tired of laying down extra cash for service that 67% of those polled want the practice abolished. Our colleagues at CTV filed this report.
A lot of Canadians say they're pretty much done with tipping.
I think it should be included in the price. You shouldn't be asked to tip.
Just because you're doing your job doesn't mean you need to be tipped for doing your job.
Many businesses implemented suggesting tipping options during the pandemic, but now the expectation to leave a tip has some customers saying it's gone too far.
I used to love tipping extra for really good service, and I feel like that's kind of gone away now. Even for bare minimum service, they expect 18-20%.
And they're not alone. A new survey by H&R Block finds 2/3 of Canadians want to do away with the practice. And nearly 9 out of 10 people say they resent businesses that ask for tips at places where they don't feel tipping is necessary. And 4 out of 10 people say they avoid going to places that ask for tips at the register, like fast food places, coffee shops, or self-service counters.
I go to Chuck's here quite a bit. They don't ask for a tip. And the service is fantastic.
At Chuck's Deli and Convenience at train yards, tips aren't expected, but appreciated.
They have a tip jar, which is optional at the counter, which I do quite often with them because the ladies are fabulous.
The owner believes all tips should be left up to his customers.
Some good customers like to, and some people they don't. They walk out without tipping. One guy, construction worker guys, he grabbed a $50 and he put it for a lady. So you never know.
Chicken, pickle, vegetable?
But getting rid of tipping could affect the day-to-day operations in the service industry, and at restaurants, it could mean higher prices for customers to offset the loss of income to employees.
I would assume it would be included in the price. I mean, minimum wage is quite high already, so if tipping were to be taken away, I don't know what that would look like. I don't know what the workforce would look like for that.
But many say the tip options make them feel guilty or pressured.
Even though we feel annoyed by this question for the tip on the machine, 57% of us, so more than half of us, will give a tip anyway.
Kimberly Fowler, CTV News.
Stay with us. The opening bells are next. Here are the opening bells at the NASDAQ. Amplify Her Foundation is ringing the opening bell this morning, and at the New York Stock Exchange, Edison Electric Institute rings the opening bell. It's time now for the first 15. This is BNN Bloomberg. Trading day is just getting underway. We're going to check in on the equity market to start this Thursday morning. We'll begin with the TSX, which was down quite a bit yesterday to end the day, of course, after that rate decision by the Bank of Canada. And also, we're watching the oil prices and gold prices, all big factors in terms of driving the TSX. Currently right now down by more than a full percentage point to start the day at more than 31,000 points. If we look at the U.S. markets, they were all trading down in the pre-market, still doing that right now. S&P 500 down by a full percentage point, NASDAQ down by more than that to start the day. And we'll take a look at some of the big Canadian companies we're watching for, particularly one of Canada's largest energy companies, that's Suncor, surging as surging energy prices remain in the spotlight. You can see Suncor is up by 0.5% to begin the day. We're going to keep watching these major energy companies in Canada because obviously what's happening in the Middle East in terms of driving up those oil prices, very much affecting these companies here at home. Some others that we're watching for, MDA Space finished top of the TSX yesterday, trading down a bit this morning, almost 3% to start the day. But yesterday's high comes after the company won a $32 million surveillance contract from Canada's Defence Investment Agency. Under this contract, MDA Space will be building three ground-based optical observatories. And this is just one of many contracts this company has been signing with the federal government in terms of defense. We're also watching Seabridge Gold today. It was down 13% yesterday, one of the worst performers on the TSX, the most in 7 weeks, and it's one of the worst performers among its peers right now. Right now, it is down by more than 12% to start the day. So we're going to be watching the price of gold. It's been dropping. It's on a 7-day lose streak, and obviously you're seeing these gold companies reflecting that downward price from the price of gold. So we'll keep watching that as well. And for movers south of the border, we are now joined by Bloomberg's Janine Panzer to take us through a couple of them. Janine, you're also watching Canadian Solar. That's falling on earnings, revenue, missing forecast. Tell us more about the latest report.
Yes, this is a name that's familiar to Canadian investor. Canadian Solar is tumbling at the open after its earnings report. The company is posting a wider than expected loss and issue a weaker outlook. Revenue is coming in light. The weakness here is tied to lower solar shipments and a drop in global energy storage volumes. And the company is also flagging delays in project sales, with some of those slipping into next year. Our colleague from the Bloomberg intelligence side is saying that the firm's outlook suggests a sharp drop in shipments, with oversupply and delays likely to weigh in the near term. So the company is saying that it's focusing more on margin right now and shifting towards energy storage as a growth driver. But for now, investors are reacting to the weaker near-term outlook, Lindsay.
We're also watching shares of Alibaba today, down at the moment. This comes after a profit plunged 67%. What's going on with that company?
Yes, Alibaba is under pressure this morning after its earnings report. Exactly like you say, a sharp drop in profit, plunging over 67%. So what's happening here is that because the company is spending more to keep up with rivals in its core e-commerce business, and at the same time, their sales only rise about 2% to roughly 285 billion yuan, and that came in just below expectation. Now, what is the company doing to turn things around? Well, Alibaba is pushing deeper into AI and cloud to try to drive profits. It's rolling out AI tools for clients and even charging more money for some of its cloud products. The goal here is to lean on its AI to offset pressure in the e-commerce sector.
Okay, we will leave it there. That is Bloomberg's Janine Panzer joining us live. Janine, thanks so much for that update. And coming up, are we looking at a 2022 style downturn if the Iran war drags on and the Strait of Hormuz remains closed? We will break it down right after this with Barry Schwartz. Markets continue to fall and oil prices are rising again as the Iran war continues to escalate across the entire Middle East. So will the market's bull run driven by AI be sustained, or are we looking at more of a downturn? Let's unpack all of that with Barry Schwartz, CIO and portfolio manager at Baskin Wealth Management. Hi, Barry. Good morning. It's good to have you join us.
How you doing? Thanks for having me.
So you mentioned the market's already priced in this a short war, if this is in fact a short war. What impact do you see, though, if the war is actually prolonged? Is there a chance we could move into a recession?
Well, it's either going to look like 2022 or 2025. In 2022, of course, the Russia-Ukraine conflict, and it's still ongoing, of course. You see how markets do eventually discount the issues. But, of course, it's a shock to the world and a supply shock. And obviously, the rising price of oil and natural gas, more so, of course, in Europe, could lead to another round of higher inflation, no rate cuts, really throw off the plans that the U.S. administration had for this year. And of course, the bottom line is markets could kick a tumble as a result of that if it drags on. Absolutely, we could see very similar knock-on effects that we saw in 2022. Mm-hmm. But the opposite, of course, is 2025. Remember, we were all so depressed about the tariffs, and we all knew the impacts, and it was going to be horrible, and the markets were going to go down. And then by May, of course, it was all over, and the market started to recover. So obviously, this is a different scenario. I liken it more to the 2022 scenario. And so we all have to hope for a quick end. And if it ends by the end of this month, I think the markets will rebound quite violently as a result.
If oil prices do stay elevated for a long run, like more than the end of this month, as you're saying, and we do see a return to that 2022 style inflation, what would that do to the AI-driven bull run that we've been seeing?
It's hard to know what the knock-on effects are going to be. Obviously, the companies have committed capital expenditures to build out. If the economy starts to slow, they won't. They will stop buying chips. They will stop buying. People aren't going to travel anymore. If the price of oil and gasoline is going to impact the price of commodities and goods, then you could look for really a tough problem for the economy, and the knock-on effects will spill over. That being said, we have to obviously take a look at the price of oil, where it is today, the price of natural gas, and look at it in the context of where it's been over the last number of years. Is $95 oil outrageous? No. Is $3.20 natural gas price outrageous? No. But no question, the prices are much higher in Europe, and that's where the impact is going to be. If you look at it historically, inflation adjusted, oil prices are not expensive at all, and the economy can very easily digest it. We also have to keep in mind that we have a much different economy today than we did 20 years ago, or whenever, if you recall the Iran conflict multiple years ago when inflation spiked. The economy is not as much driven by oil as it was many, many years ago, but still, you can't deny the impacts.
Given everything that's happening right now, correct me if I'm wrong, you think this is more of like a buying opportunity rather than a warning sign. Is that right? And if that's so, walk us through why you think that.
I'm a long-term investor, so I use every pullback in the market as a buying opportunity, and that's just the way a long-term investor should think. It's a gift every time the market adjusts, and it's not a surprise what's going on now, and it's not like stocks haven't reacted. You see the impacts. You have many. The only thing that's working is oil and gas companies. By the way, I'm pretty happy that gold's not working, because it just goes to show you that everybody's pounding the table. Gold's got to work when things are going crazy and things are uncertain. No, it doesn't. And so I really want investors to focus on the long term. Own great businesses. You've been through this before. You've been through so much uncertainty. This is, this is nothing compared to what happened during the pandemic or 2022. Maybe it will be, but for now it's not. And you have to really focus on companies that are excellent at allocating capital and have been through tough times before. This is the way the world works. And so I'm going to focus on what matters, and that's corporate earnings. And so far, have been very, very good. And I'm still expecting double-digit return on earnings this year, and hopefully the stock market will follow suit.
Yeah, okay. It's very interesting what we're seeing with the markets right now. I want to narrow into a couple of different companies, though, switch gears just a little bit. I wanted to ask you about Micron. So this company reporting strong earnings, tripled its revenue in the latest quarter, beat analyst estimates, but there's some big spending planned for this company, and we're seeing that reflected in the stock price today. What do you make of what we're seeing with Micron and the stock's response to these earnings?
So what's going on, of course, with the semiconductors is unbelievable, right? So we all know that in the past, semiconductors were very much a boom bust type business. They would all make too much money and make too many chips, and then we would have some kind of pullback in the economy or what have you, and Micron and those similar companies would tumble, because it's really a commodity type business. It's memory and storage. They're not making special design chips like NVIDIA, but that being said, the stock, look at that. It's moved up incredibly. Yes, the numbers were unbelievably insane. I think they are guiding for $19 a share in one quarter. So something just blow away. But what the market obviously focusing on is how long is that duration of this demand going to last? And of course, what's going on with the world now, that could have knock-on effects. You just don't know. So the investors are right to be skeptical about these companies, but honestly, the numbers that all these companies are producing, NVIDIA said they're going to do $1 trillion of revenue on AI in 2027, and the market didn't even react to that. So right now, markets can't focus whatsoever on any fundamentals. It's all about what's going on in Iran. And until we get away from that narrative, expect stocks to be extremely volatile.
Okay, we're running out of time, but I did want to get to at least one of your stock picks for today. That's TMX Group, which has been losing listings on the TSX, but you're still bullish on this one. Why is that?
Listings is not how they make a lot of money. They make money on trading, on volatility, on derivatives, on also selling software and subscriptions. The listings business is really much a cash cow. But TMX Group, we think, is going to grow by double digits for many years to come. It had a terrific 2025. The worry was as we head into 2026, there'd be less volatility in the markets. Well, hello, here we are. Lots of volatility. People trying to do lots of crazy stuff to try and protect their portfolios, buying options, going into different markets. And of course, with the strong rise in the TSX, we expect more listings and more new issues to come. So very exciting time to buy into TMX Group. It should be trading at $60 a share, but this is the market we're in right now. So we see lots of great opportunities and high quality predictive companies here.
Okay, we've got time for your last pick as well. So that's Berkshire Hathaway. What do you like about this one?
I love the new CEO, Greg Abel. Right off the bat, he wrote a gigantic shareholder letter laying out exactly what he sees and how he's going to play it out. Also, really putting the critics to rest, saying we're going to buy back stock if we want. We can do M&A. We're not just sitting on our hands. I said last year that Buffett was preparing the company to hand off to Abel, and he wasn't going to do very much. Now, Greg Abel's time to get going. What can be more defensive than having a company right now with almost $400 billion in cash, 40% of its market cap, as well as the ability to buy back tons of stock here. And if the market continues to weaken, we may see Greg Abel start ramping up the M&A. So very exciting time for a high quality business trading at a very reasonable valuation and guiding and telling you that they're going to be buying back stock here at these valuation levels.
Okay, Barry Schwartz, CIO and Portfolio Manager at Baskin Wealth Management. Appreciate your time today. Thanks so much for joining us.
Take care, everybody.
Yesterday on Market Call, we were joined by David Burrows. He's chairman and CEO at Barometer Capital Management, and he was covering North American large caps. These were the top picks: GE Vernova, Canadian Pacific Kansas City, and Cash. And today on the show, we have Ross Healy. He's chairman at Strategic Analysis Corporation, and we'll be taking your questions on North American large caps. So be sure to stay tuned for that. Up next, Canopy Growth CEO on the company's latest move and what the MTL Cannabis acquisition means for the next phase of growth. That conversation coming up. Canopy Growth has officially completed its acquisition of MTL Cannabis, a move that creates what the company calls Canada's leading medical cannabis platform. And for more, we were joined by the CEO of Canopy Growth, Luc Mongeau.
For us, medical cannabis is extremely important. Why is it important? Because it provides tremendous benefits for medical patients across Canada, veterans. For example, it is a segment of the cannabis industry that is a bit more stable, but it comes with a higher set of regulation. So imagine the product are pharmaceutical grade. So it really drives the organization to have superior level of performance, superior norms, processes, and everything. And for us, becoming number one in Canada, obviously it comes with financial benefits. But it's going to allow us to provide superior service, care, and products for veterans and for patients who really rely on cannabis to improve their lives.
There is a shift, correct me if I'm wrong, in this industry in Canada away from just recreational use of cannabis towards medicinal use. Is that right? Are you seeing more of that?
Well, both sides are doing extremely well. And what we're seeing is more and more Canadians and actually more and more consumers around the world are turning to cannabis as an alternate source of care or an alternate source away from alcohol. The new generations, we've all seen the reports, consume less alcohol and they turn to cannabis for recreational use.
I know Canada exported more than $350 million in pharmaceutical grade cannabis last year. So What kind of gives Canada this edge over some of the other global competition?
I mean, we've been at this for many years. The regulations in Canada are relatively high, which really drives the licensed producers in Canada to produce really high-quality products. So for us, we're really excited with the acquisition of NTL because NTL is known as one of the best grower in Canada, very high-quality products, which will position Canopy to really accelerate growth in the international market, especially in Europe.
Even though more countries are kind of ramping up domestic production, you feel confident that Canada still has that upper step and that your company has that kind of higher level?
Absolutely. I was talking to regulators and to distributors in Germany yesterday, and we're saying that, there are many entries coming from other markets around the world at cheaper prices, but they do not meet the level of quality and consistency that's achieved in Canada right now.
Interesting. So if you're looking at other countries, particularly in Europe, I think you said, what countries, is there any specific countries that you're looking at that have more demand?
Yeah, absolutely. The German market is growing extremely fast. The Poland market and the UK market is opening as well. It's all medical business. So for us, that's why, the acquisition of NTL and get access to superior quality flower will really allow us to double down on our growth efforts in these geographies.
What about expansion into the U.S.? What does that look like at the moment?
Well, the U.S. market, as you know, is limited right now. And there's a lot of rumors of when. It's no longer if. So we know it's going to happen. It's when.
In other states, you mean?
No, when they will open up the market and deregulate the market. So for us, what's important at Canopy is we've got significant investments in the U.S. We've got investment in Canopy USA. We've got a limited investment in TerraSense. So we're well positioned to benefit when the U.S. market opens up.
Do you know, I know you maybe don't know exactly, but a rough timeline of when you're hoping maybe that market will open up?
I won't speculate on that. There's a lot of rumors out there. For us, what's really important is that we put the right basis in the U.S. so that when it opens up, when it deregulates, we're well positioned to grow there.
And we know Prime Minister Mark Carney, he set that ambitious goal to double Canada's non-U.S. exports within the next decade, so kind of looking away from the U.S. How do you think your industry and your company fits into that?
Well, to what you said earlier, the Canadian cannabis industry grows extremely good quality flower with very high standard, and that flower is in high demand across the world. So everything that can be done to ease up the regulations that are put on the Canadian LPs to really allow us to be able to be more profitable, to reinvest our business, to increase production. All these will allow us to win globally. Canada really has an opportunity to be the global exporter of cannabis, the largest in the world.
Wow. Let's talk a little bit more about this acquisition now that it's complete. How does that work? How do the two companies merge together with employees and all that? I mean, is that all finalized and done?
Yeah, we're very excited. The transaction closed on Monday. Obviously, we've been working on the integration plan for a while now. The main focus right now is really ensuring that we've got continuity and that both businesses continue to work and be reliable and provide superior service. So we started integration on Monday morning. We've got a very solid plan, and we plan on delivering significant synergies over the course of the next 18 months.
That was Luc Mongeau, CEO of Canopy Growth. Up next, stocks are plunging in Toronto today as gold drags our benchmark index lower. We've got more on that and which stocks we're watching right after the break. Welcome back. We're going to take a look at the markets this morning because there's some interesting things happening, particularly on the TSX. It is down, and if you take a look at the last week, it's been dropping, particularly yesterday, losing 600 points to end the day yesterday. And we're watching the TSX closely because there's certain sectors that seem to be getting hit hard today, including the materials sector of the TSX. It is down by more than 7% at the morning. We're starting to see a sharp sell-off of precious metals this morning as investors worry about what's happening in the Middle East. And you're seeing that reflected in these numbers here. If we take a look at the worst performing stocks on the TSX, that's some of the mining stocks that we're talking about. G Mining Ventures down by almost 12%, Discovery Silver down by more than 10%, and K92 Mining also down by more than 8%. Again, people are wary. We've seen the price of gold dropping over the last couple of days, and now we're seeing that reflected in these mining companies within the TSX, which is dragging the TSX down. On the flip side, though, because we're seeing oil prices going up, we're going to take a look at some of the top gainers on the TSX, and that is a lot of energy companies. Parex Resources up at more than 3%, Methanex Corporation up by 3.4%, Vermilion Energy up by almost 7% at the moment. Again, all benefiting from these rising gas prices, given what we're seeing in the Middle East, developments happening overnight in terms of more airstrikes from both sides. And we're seeing the Strait of Hormuz still controlled, therefore less oil getting through, driving up the price of oil. And you're seeing that reflected here. We'll take a look at the U.S. markets as well to start the day. They were trading down. They still are. S&P 500 down by 0.5%. Same with the Dow Jones. NASDAQ down by 0.6%. Investors, again, wary. We also saw those rate decisions come out yesterday. Not much movement. That seems to have already been priced into these markets. But we're watching, again, the price of oil, as I mentioned, oil and gas prices jumping amid these escalating attacks in the Persian Gulf. Oil up today by 0.9% at the moment. You can see just in the last month just how much it has spiked because of this war, this ongoing war, and worries that it will be prolonged. And again, as we mentioned, the price of gold, the Iran war is continuing to punish the metal market, and we're seeing that the price of gold down more than 5% at the moment. Yesterday, gold fell for a 7th session, and we're waiting to see whether we make it 8 today. And then the loonie, of course, trading relatively steady this morning. So we'll continue to watch all of these for you. Just ahead, shares of Micron Technology are under pressure, and we'll have more on that, as well as some other stories and some stock picks for you. Stay with us. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. U.S. President Donald Trump is calling for de-escalation after Iranian and Israeli strikes hit major energy sites across the Middle East. An attack on Qatar's Ras Laffan gas hub caused significant damage, while Israel struck Iran's key South Pars field. Trump says the U.S. was not involved in the Israeli strike and warned Iran against further attacks on regional energy infrastructure. Uber plans to invest as much as $1.25 billion U.S. in car maker Rivian Automotive to help launch a robo-taxi fleet that will be available in Canada, the U.S., and Europe over the next 5 years. Uber and its fleet partners will buy 10,000 autonomous Rivian R2 robo-taxis and will make them available exclusively on the Uber app starting in San Francisco and Miami in 2028. And AutoCanada swung to a fourth quarter loss on lower revenue. The Edmonton-based multi-location North American automobile dealership group says its fourth quarter performance was shaped by a more challenging market backdrop. Demand was affected by activity like the sunset of Canadian EV tax credits, which benefited the fourth quarter of 2024, and tariff-related policy changes that drove stronger demand in the first half. And we're watching the TSX this morning trading down at the moment by 1.5%. We're seeing that sharp sell-off in the precious metals sector, which seems to be hurting the TSX today. Also, U.S. markets seem to be trading down this morning. We're going to watch for any upturn. You can see S&P 500, Dow Jones, and the NASDAQ currently all in the red. And shares of Micron Technology are under pressure despite reporting its quarterly sales nearly tripled as demand for its product outpaced supply. Let's find out why the stock is selling. Joining us now is Grant White, portfolio manager and investment advisor at Endeavor Wealth Management. Good morning. It's good to have you join us.
Yeah, good morning, Lindsay. Thanks so much for having me.
Let's talk about the reason why Micron might be under pressure this morning, shares of Micron.
Yeah, I mean, this was a really great report, and we've seen great reports in other AI-driven stories, recently. And so I think this is largely profit taking that's coming off the table. I mean, obviously we understand the environment that we're in. There's a lot of volatility out there. There's a lot of uncertainty out there, and you've got a company here that's up over 350% or so over the last year, or 325%, as you're pointing out here. So I mean, I think this is a lot of profit taking, but we still really like Micron. I don't think that the story is anywhere close to being over for this company yet. We've got at least a couple years worth of catch up in supply related to memory, and as long as we're not wrong on what AI is the build out's gonna do over the next few years, I think Micron is gonna do very, very well. So I think that ultimately what you're looking at here is potentially a buying opportunity. It's not that the company's cheap per se, but the growth story is certainly there, and there's a lot of wind still in their sails.
It seems to be, Micron talking about high spending in the next couple of years. Is this just some concerns as well from investors in terms of all this excessive spending we're seeing from these big companies?
Oh, certainly. I mean, I think the story is really turning into what's going to be the ROI on this big spend that's going on, right? And we were seeing companies spending hundreds of billions of dollars on new build outs and so on. And so, yeah, I think naturally the story has to shift to that. Now, I think this is overblown in the case of Micron in particular, because I mean, frankly, there's only a few players in this game as it relates to memory, and there's a long way to go before they're actually able to meet up with demand. And so I think the story is long. I think the spend out is warranted, and I think that that Micron's going to do very well in it. But I do think you're touching on a broader story that we do need to start looking at the spend here on a lot of companies and wondering, is the ROI going to be there?
Yeah, it's an interesting conversation as well in terms of people's patience, in terms of seeing that ROI. I know you have some stock picks. I do want to get to those, but first, just kind of looking at the broader market, it's been interesting to say the least over the last couple of weeks or months. You say you think markets can move higher from here, but not in a straight line. So what do you mean by that?
Yeah, absolutely. I mean, I think to say it's been different in the last little while is an understatement, obviously, with what's going on. And so, what we expect here is lots of volatility, and that's exactly what we're seeing. We're seeing lots of ups and downs. I think we're going to be a bit range bound at some point here pretty soon, until we get a little bit more certainty about what's going on. But I think that the markets, there's a lot to like about these markets too, and I think that despite the atrocities going on, what you need to look at is the buying opportunities that are being created here. So focusing on fundamentals, there are some great companies that were frankly just overpriced and were really difficult to get into not too long ago, and we might be seeing a buying opportunity here because the fundamentals behind them were strong before. We just didn't have a good pricing, and so I think this is going to create an opportunity. But you got to be very aware that the next few months are likely going to be quite volatile, and so being willing to take the lumps is probably going to be necessary in order to do well in this.
Okay, so let's go through some of your picks. Strathcona Resources, what is it that makes this stock interesting to you?
Well, I think they're like primed in the story here. I mean, I think that one, they're a great producer. We love our Canadian producers, and I think that they're really well positioned here to do well. Obviously, with oil prices higher, they should do quite well in that. And what they've been able to demonstrate though beyond that is that they're great managers. They're great. They've been really able to manage their costs. One of the things that we like, I think the understated story here is also the share buybacks. I think were recently announced. And so, if you look at their dividend yield, if you add their share buyback yield, I mean, I think you're looking at about an 8% yield per shareholder around there. So just to hang on to this thing, you're getting about 8% yield overall. So long story short is I think the story is really strong. I think they've been great allocators, and you're getting a really nice yield. They kind of wait for it.
Also, CNX Resources, another one that you like. Why do you like this company?
Yeah, CNX is a great story as well because, I mean, again, they're really playing into the story of like energy here, obviously with the natural gas producer. But what makes CNX really unique is their ability for cost control because they own part of the pipeline. They own the midstream part, and so they're really able to manage their costs better than a lot of their competitors will, and also their direct access to market. And so, long story short on CNX is that they're just way better positioned than most other energy producers to manage their costs. So when natural gas prices are kind of normalized, they do well. When natural gas prices rise, they do really, really well. And so they, I mean, it's just a really great producer that, again, I'd hold it up against any of their competition just because of that cost control.
And Constellation Software, another company that's been on the rise a little bit as of late. What is it that you like about Constellation Software?
Well, I think that the SaaS like being blown up story is overblown. That's the thing. I mean, I think that what we're starting to see in the AI story now is that where you need the rubber to hit the road, and I think Constellation is a company that's going to have the rubber hit the road really fast, and largely that's because of their ability to integrate AI into a lot of their systems or a lot of their software systems that are already out in the marketplace. So I think they're going to do really well in that. But this stock's been beaten up, as we can see over the last little while, over the last year, because everybody thought that software was dead for a while, and I just think that's not the case at all. I think that if anything, AI is going to be used to enhance their offering and what they bring to the table. And Constellation has demonstrated for decades that they have the ability to manage through storms, and they have the ability to acquire great companies, and I expect that's going to continue on. They didn't become bad managers overnight, so I think that's going to continue on. And in fact, I think AI is going to enhance the story. They're going to get they're going to be able to reduce their costs, improve their margins on their existing product line, and they're going to do very, very well.
And lastly, Thrive Holdings, shares are climbing today, and you have a buy on this stock. So what does it like about Thrive Holdings?
Well, Thrive's kind of the same story, actually, as Constellation. I mean, this is, for a lot of people that don't know this is like a legacy Yellow Pages business. But what they've been doing over the last, well, we'll say a little while, but over quite some time now, is converting Yellow Pages customers into software customers using, and then what they're targeting is, this is not competition to companies like Salesforce or Microsoft. They're targeting like small and mid-cap type companies that really can't afford the services that like a Salesforce would provide. So they're in a really great market space, and they're converting over to like CRM systems and software systems that will help them to improve their business and data mining. And again, the company largely been beat up, I believe, because of everybody thought software is dead. But I think that Thrive's going to do a really good job of integrating AI solutions into their technology. And so I think they're far from dead. I actually think the story is just starting, and they're actually going to be really improved over in the coming years. So I think this is one to watch out for.
Yeah, especially as you say, that software story is so interesting. Okay, that's all the time we have. Grant White, portfolio manager and investment advisor at Endeavor Wealth Management. Thanks so much for your time. Appreciate it.
Thanks so much, Lindsay.
Coming up, hiring is slowing on both sides of the border, but for very different reasons, as Canada and the U.S. tell very different labor stories. We'll be back in a moment. Labor markets in Canada and the U.S. are slowing, but apparently not for the same reasons. America is seeing productivity gains from AI, while Canada is absorbing trade-driven job losses. So to break down what this means for workers and the broader economy, we were joined earlier by Michael Hakes of Murray Wealth Group.
Both the U.S. and Canadian labor markets through both 25 and 26, and both have been cooling for different reasons, as you mentioned. U.S. is actually experiencing an efficiency-driven adjustment. And despite only modest job growth through last year, productivity is surging through late 25, up 2.8%, even as total labor hours actually have declined. And this is an important signal, as you mentioned, that generative AI may be beginning to deliver measurable output gains. And all that money that we've seen hyperscalers spending on CapEx may be starting to deliver revenues. And this shift has been most evident in the technology and white-collar sectors, where firms have announced well over 150,000 layoffs since late 25, including major reductions that have been directly related to AI adoption. Meta, for example, earlier this week announced 20% labor force cut. Amazon late last year announced cuts. And this is all showing this that companies are prioritizing automation and AI-first type strategies over incremental hiring.
And I mean, in previous industrial revolutions, there's always been the concern these jobs are gone, they're never coming back. But usually we've seen more jobs created because of that. Do you feel that will happen with AI? The big concern has been it won't. Do you feel, though, that people are starting to see a positive side to what AI might bring?
Yeah, that is the big debate in terms of how fast new jobs will appear versus how fast new jobs may not appear in the short term, because you're leveraging individual employees. So I can do the job now. Maybe I can't do the job, but younger people could do, younger people who who would normally, you would need 10 on a team, you may need only 1 or 2 on a team before. So what that's done is entry level and recent grad hiring is really unemployment wise in terms of the States is around 8%. Whereas pre-COVID, you saw those levels around 6. So we could be seeing early days in less entry-level type jobs because companies are able to leverage what they currently have in-house. You may not necessarily see people getting fired so much, but there'll be less hiring at that lower level.
All right, and then going to the Canadian side, different reasons having an impact on the market there.
Yeah, as you mentioned, we're seeing much more external macroeconomic shocks in Canada affecting the labor market. You know, trade uncertainty and tariff pressures have driven recent employment losses, pushing employment, as we know, to 6.7% or so. And sectors such as retail and finance have weakened, while healthcare has provided some limited support. And healthcare is also strong in the U.S. in terms of hirings. And back to Canada, although AI adoption has doubled to 12% in 2025, it remains largely augmentative rather than a displacement-driven technology in Canada. So both economies, when we look at the U.S. and Canada, are now operating in what you could call a low hire, low fire kind of environment that protects existing employees, but makes entry-level workers more difficult to find job.
Which is the better situation to be in, the trade concerns or the AI concerns?
If you believe the trade concerns are more cyclical, then that's probably better for the labor markets because you get hired if you get a pickup in terms of industrial sectors, oil and gas, and that sort of thing. If you're in the States where you're much more service sector driven, it could be a bit ominous thinking about if you're a student or a young grad, what your prospects are when you enter the labor force.
And so where are you looking then for opportunities with this?
We're looking for opportunities in companies that can leverage their Gen AI. So we're well positioned in the Googles and the Microsofts and the Metas, the hyperscalers who have all spent billions of dollars, as we know, on CapEx. And the market's concern now clearly is show me the revenues, essentially. So we're entering that phase where the market is skeptical on the CapEx spending. Will they ever see a return on that CapEx spending? So hopefully we're at an inflection point where we can see through the end of this year those revenues coming through.
That was Michael Hakes of Murray Wealth Group. Okay, let's take another check on the TSX because we're watching it very closely today. This is a one-week chart of the TSX. Today, it's down by more than a full percentage point, and we're seeing this sharp sell-off in the precious metals sector, which, as usual, affects the TSX because there's so many mining companies within. And some of these companies are definitely suffering today. You can see Endeavour Mining down by more than 6%. G Mining down by almost 11%. Same with Silvercorp Metals. And we saw the TSX yesterday sink 600 points, and we're watching to see what exactly happens today. Torex Gold is another one that's down by almost 9%. NGEX is down by almost 10%, and Discovery Silver down by almost 10%. Obviously, investors really weighing right now what's happening in the Middle East. The price of oil is going up. We're seeing the price of gold going down, which obviously is affecting these companies quite a bit. There is some upside, though, I guess, on the TSX. A lot of energy companies within Canada seem to be benefiting from the price of oil being up so much. You're talking about Vermilion Energy, also some fertilizer companies, too. And yeah, we're watching those closely as well. Coming up, the ETF report is next. Stay with us. It is time now for the ETF report. Our next guest has 3 picks for us, but first, let's get his perspective on the market. So joining us now is Paul McDonald, President and Co-Chief Investment Officer at Harvest ETFs. Good morning. Thanks for joining us.
Thanks for having me. Great to be here.
What is your take on the direction of the markets today, particularly what we're seeing with the TSX? It's interesting to see kind of that sharp sell-off in the metals sector.
It is not unprecedented when we look back at historical liquidity events when people are looking and getting very nervous. We do see some of the golds do tend to sell off, even though the commodity price remains very high, and the miners are absolutely making great cash flows at these prices. When we take a step back at the broader markets, though, it's been a very challenging time. Everybody knows. Everybody's an expert in the Straits of Hormuz now. The duration of the war is unknown. Its implications are unknown. But when we look where we've been over the past 18 months, there's been a lot of geopolitical risk in the marketplace, trade wars in Eastern Europe and the Middle East. But even our own sovereignty has been questioned, yet the markets have trekked to new highs during that period. So when we look at what's happened in the past, call it 6 to 8 weeks, we've seen prices correct very meaningfully. Earnings are still resilient. There's an unknown, that is the risk. But in general, when we look at the U.S. markets in particular, we've seen very significant corrections in valuations. Markets don't correct as they move higher on valuations, and they don't bottom. But certainly we're seeing some great attractive entry prices in some of the areas that were perhaps a little bit lofty, even as short as late last fall.
Many are saying this resiliency we're seeing within the markets could be hurt if this conflict in the Middle East drags on. Do you agree with that assessment, or do you think there's other factors that could hurt the resiliency of the markets, or do you not really see that happening?
Look, the duration of this war could absolutely be an impact. It is a tail risk, I think, still at this stage. Again, we don't know how long this is going to go on for, how much it's going to escalate. Fear and all the various types of metrics that we can measure, bull-bear ratios, fear-greed ratios. People are scared, and we're seeing that being reflected not only in broader market volatility, but in the valuations as they've been pulling back. So yes, there is that risk. We do think that that's at the tail end, meaning that we think that this potentially has the potential to be relatively short-lived and a return to normalcy. But there's always that risk that this continues for a longer period. And because of that, we want to make sure in this environment that we're having those anchors of defensive areas in our portfolios that really, proven over cycles to generate consistent cash flow, whether it's healthcare or utilities. But absolutely, this pullback, we do see an opportunity arising in some of the tech names in particular.
Interesting. Okay, so I take your point that there's certain sectors and tech names that could be good anchors, but in terms of ETFs, how does what we're seeing right now in the markets make for a good entry point into ETFs?
Oh, look, I think the best time to invest is when you have capital to invest. And for those that are looking at the current environment, deploying capital seems to be a great opportunity. I think if we can look through even the next quarter, looking at some of the higher growth names, this infrastructure spend that we're seeing in the U.S., the AI build out, it's not made up. It is absolutely an unprecedented amount of infrastructure build out. And that's happened and is happening and is going to continue to happen on all this capital expenditures. That's going to filter through into the broader economy. And we started to see that. We started to see that. You saw equal weight indices, tech indices starting out to outperform on the equal weight side. So within our suite, our tech achievers, HTA is a great example. You get a basket of 20 large cap tech stocks. We do have an option overlay, pays a very healthy distribution. And so that would be somewhere we'd be looking in these types of volatile markets when we get pullbacks, and especially with valuations pulling back, 7x multiples in basically a 2-month period. Not unprecedented, but those are big moves in valuations. So we do see opportunity in that space.
Okay, so you mentioned HTA. That's one of your picks for today. We can go through that in more detail if we have time, but I wanted to start at the top in terms of your picks. Harvest Equal Weight Global Utilities Income ETF. What do you like about this one?
Yeah, look, just like the consistency of the cash flow, utilities, telecoms, even the pipelines tend to be more defensive in nature. And so having that as an anchor and just generating that consistent cash flow and growing cash flow over time. In this type of environment, we think makes a lot of sense. We do have North America and Europe in our portfolio, and we because of the AI infrastructure build out, and everybody's talking about power demand really accelerating. That's not going away, but really to benefit from that, we need to have exposure into the U.S. and into Europe. So hence, when you look at the relative performance, over short, medium, and even over the past, call it 5 years, that has really been a key driver, and we don't expect that to change. So 30 equal weight utilities, telecoms, and pipes, great way to get exposure to the sector, a little bit more defensive in its nature, but still getting that growth from the AI infrastructure build.
And just lastly, you mentioned healthcare as one of those anchors. Another pick today is your HHL ETF. Tell us about this one.
Sure. So HHL, largest healthcare ETF in the country. It takes 10 years to get that 10-year track record, consistently paying that monthly distribution. Up until earlier, about 6-7 weeks ago, healthcare had been performing relatively well. This latest pullback, we don't have any direct lines we can point to policy or company specifics. It's really been caught up in this market pullback. And so the permanent non-cyclical drivers, aging populations, tech innovation, developing markets, are still very much intact. A lot of the policy clouds last summer have dissipated. So absolutely advocate adding to these core companies that even if we do end up in one of these tail risk situations of a prolonged war, healthcare is a superior good. We need it in up and down economies. So I absolutely think healthcare is a great addition here for portfolios, especially on that defensive side.
Okay, Paul McDonald, President and Co-Chief Investment Officer at Harvest ETFs. Appreciate your time today. Thanks for joining us.
Thanks for having me.
Coming up, our next guest says after covering stocks for 20 years, he's never seen a company with this much upside. We'll tell you more about that right after the break. U.S. President Donald Trump is calling for a de-escalation after Iranian and Israeli strikes hit major energy sites across the Middle East. An attack on Qatar's Ras Laffan gas hub caused significant damage, while Israel struck Iran's key South Pars field. Trump says the U.S. was not involved in the Israeli strike and warned Iran against further attacks on regional energy infrastructure. Eli Lilly says its experimental diabetes drug retatrutide delivered record weight loss in late-stage trials. Patients on the highest dose lost an average of 15.3% of body weight, outperforming existing treatments, while also improving blood sugar levels. The results strengthen Eli Lilly's position in the fast-growing obesity drug market, where it is competing with Novo Nordisk. And Meditech has priced its initial public offering below the deal's marketing range, and the company is also raising less money than originally planned. The UK-based Meditech priced its IPO on the Toronto Stock Exchange at $5 per share, raising a total of $40 million. The company initially set out to raise $50 million. However, the shortcoming seemingly reflects soft investor demand for IPOs in Canada. And we'll take a look at the North American markets today. TSX is down by almost 2% as we're seeing that sharp sell-off in the metals sector. The S&P 500 and the NASDAQ also trading down at the moment. And while the upcoming SpaceX IPO has been making headlines the past few months, our next guest says there's a Canadian satellite company that hasn't been getting much attention, but has massive opportunity ahead. He says he's been covering companies for 20 years and has never seen anything that has this much upside. Here to give us his perspective on Telestat is David McFadgen, Managing Director of Institutional Equity Research at ATB Cormark Capital Markets. It's good to have you join us. Thanks so much.
Yeah, thanks for having me.
Looking forward to hearing your thoughts on Telestat. I mean, how does the valuation of Telestat compare to a company like SpaceX?
Well, the SpaceX is rumored to be valued. I mean, we don't know exactly because they haven't started marketing the deal yet, but what's been reported in the trade press is it'll be over $1.5 trillion US. So the valuation will be over 100 times revenue. Obviously, Telesat wouldn't be anywhere close to that, but that shows quite a value discrepancy. And so I think when people start hearing and seeing the SpaceX IPO, they'll probably look around for other companies that are similar in the space. And then Telesat will probably catch their attention, and they'll look at the valuation, see there's quite a discrepancy there. So there's potential for Telesat stock to do quite well just from the marketing from the SpaceX IPO.
Interesting. Yeah, I was going to ask you about the SpaceX IPO and how that would impact Telesat. But I mean, you say you've never seen a company with so much upside. What is it about Telesat that makes you feel that way?
Well, if you look at SpaceX as a bit of a guide, so the company started about 5 years ago from zero, and in 2025 it did about $15 billion US in revenue. So part of that is it's two components. It's Starlink, and then it's also the launch business. But SpaceX has achieved over $10 billion in revenue faster than Amazon, Google, and Facebook. So the market is literally the world, and there's big upside for space-based communications. Starlink has validated the low Earth orbit model, and that's actually taking business away from GEO, which is the geostationary satellites. And the TAM is massive, and as we all know, the geopolitics has changed. A lot of people don't want to use Musk if they have another option. A lot of people they don't want to rely on the US if there's another option. So once Telesat is up and operational, there will effectively be 3 players offering broadband from space. That'll be SpaceX, Amazon, and Telesat. And Telesat will be the only non-US service. So we think that there's probably going to be a lot of demand for Telesat's product once it's operational.
Is that what you're talking about? I know you mentioned the low Earth orbit satellites that Telesat is preparing to launch this year. Is that what you mean when you say there's only really 3 big companies that will have those satellites in space?
Exactly, yes. Sorry, I meant to, what I was describing is low Earth orbit satellites. Yes, exactly. There'll be 3 LEO constellations offering broadband up in space once Telesat is operational.
Wow. On his trip to Australia this year, and we know Prime Minister Mark Carney spoke about Telesat's kind of light speed services with the Australian government. Do you think this company has a lot of opportunities outside of Canada as well, maybe in Australia, for example?
Absolutely. So most of Telesat's market will be outside of Canada, I would imagine. I mean, they're probably going to announce a big deal with the Canadian Armed Forces. They reported their results, and they announced that they're going to allocate 25% of Lightspeed's capacity for military on military Ka band. So that's probably a large portion of that. It's probably for the Canadian Armed Forces, but they can offer that up to other defense departments around the world. So 75% of the capacity will be reserved for commercial use. And just to give you an idea of the opportunity, so Taiwan typically has its undersea cables cut by the Chinese. So if Taiwan had a satellite internet service, they would not be susceptible to that. And Taiwan has wanted to use SpaceX in the past, but SpaceX has not made itself available to Taiwan because Elon Musk generates a lot of revenue out of China. He doesn't want to upset the Chinese. So Telesat is definitely of interest to Taiwan. If Telesat signed a deal with Taiwan, that could be quite large for the company. Just as an idea, there are over 22 million people in Taiwan. SpaceX has about 8.5 million subscribers, and yet it generated about $15 billion US in revenue. So if they had a deal with Taiwan, that could be, quite material, and probably cause us to raise our numbers quite a bit.
Wow. We know Telesat does currently have a lot of debt. So can you explain the issue that they have with their debt and why you're not really too concerned about that?
Yeah, so Telesat is a bit of a complicated structure. It's a complicated structure from a corporate perspective. It's also a complicated financial structure. So Telesat's basically carved up into 2 silos, the restricted basket, the unrestricted basket. Within the restricted basket, there's a lot of debt that's against the geostationary satellites right now. So it doesn't, based on the indenture, it doesn't appear that the debt has any recourse other than those geostationary assets. And that's why the debt was trading down at 40, 50 cents on the dollar. It was scooped up by a lot of distressed debt sharks, I would say. And so now the debt's trading up into the 70 to 80 cent range. And so the company is in the middle of negotiations with the debt holders to come to some sort of resolution because that debt is maturing this year. We expect a resolution. We expect a deal. It may go to the final wire before we get one, but we do expect a deal. It's in everybody's interest to cut a deal here. And once we get a deal, then it's investable, because when I pitch it to portfolio managers, I'll say 70% of those portfolio managers, as soon as I talk about debt restructuring and distressed debt, they're just like, you know what, it's too complicated, forget it. So call me when this is all solved. So once we have a deal, then it's much more investable for a lot of portfolio managers. And I would imagine the stock will make quite a material move up on that news.
No kidding. We talked a little bit at the beginning of the conversation about Telesat and, having that competition with SpaceX, having it with Amazon's Blue Origin. What does that, just between those three companies, like, what does that competition really look like? Do you think Telesat really does stack up against its competition?
Yes. So Starlink and the Amazon LEO service will be B2C. Telesat's Lightspeed is going to be B2B. It's going after four markets: defense, government, aero, maritime, and telecom. It's already getting people to agree to a minimum revenue commitment, like a firm deal here, like Viasat, for example, signed a big deal with the company. So this is a big market, and there's room for all three players. I imagine SpaceX will continue to dominate the market. But like I say, this is the world. And the market's growing very quickly, and there's room for everybody. But Telesat's product will be is expected to be a superior product. We'll be able to offer over a gig download speed from space. So that's a pretty good product. Starlink can't do that today. What we imagine Starlink will upgrade, but Telesat will be able to offer a fiber-like service, minimal latency with service level agreements. So service level agreements will guarantee a certain amount of download speed, uptime, and so on. And Starlink today does not offer service level agreements. So Telesat's product will be a premium product, enterprise grade product, and we think it will do well in the market.
So you say you've never seen a company with this much upside. Obviously, we began the conversation talking about this. Do you have an idea of just how much upside we could see within this company? Like, where's the finish line for Telesat?
Well, so Telesat's put out a forecast. We're materially below the forecast, but I'll just say if they hit their forecast, the stock will be many multiples of where it is today.
And are we getting, I know we talked about, Prime Minister Mark Carney going to Australia, talking up this company. Are we getting more interest? Is Telesat getting more interest from different countries around the world in terms of maybe using its services in the future?
Yes. So they have a very robust pipeline. So Telesat said on the earnings call this week that it expects to materially grow its backlog this year. So we were not expecting that. We expected that it would materially grow the backlog next year, because they're going to first put up some satellites in space in this fourth quarter, I think December. Then they would share the performance metrics off those satellites with potential customers. And that's when we expected the backlog to grow. But they indicated on their call this week that they expect to materially grow their backlog this year. So that clearly indicates that there's significant demand for the service. People are wanting to lock up capacity in the service before it goes live to ensure they have that capacity, and we're already seeing that.
Okay, that's such an interesting conversation. We'll leave it there, though. David McFadgen, Managing Director of Institutional Equity Research at ATB Cormark Capital Markets. Appreciate your time. Thanks so much.
Thank you.
Coming up, Hot Picks is next. We'll zero in on three plays in the retail sector right after this. Stay with us. Welcome back. It's time now for Hot Picks, and today we are zeroing in on the retail sector. Our next guest has O'Reilly Automotive as his top pick, pointing to steady growth with expansion ahead for the auto parts retailer. So joining us now is Stephen Zaccone, Senior Analyst and Equity Research at Citi. It's great to have you join us. Thanks so much.
Thanks for having me on, Lindsay. Great to be here.
Yeah, so O'Reilly Automotive, we'll start with that. You say this company has been the leader of consistency among the auto parts retailers.
Yeah. Consistency in the auto parts retail space, one of the best executors in all of retail, right? Auto parts retail is a great defensive subsector in the retail backdrop. It's a needs-based category, right? In the midst of kind of higher interest rates and consumer, tightening budgets, you're going to have to continue to repair your existing vehicles. So this business really serves that kind of sweet spot. And you think about the opportunity for market share gains, they've been the big market share gainer relative to some of the independents and some of the other players in the space. But O'Reilly's really best in class when it comes to the auto parts retail segment.
Is there any downside risk to your buy rating on this company?
Yeah, I mean, we're in the midst of a very macro tape, right? Like obviously, oil prices are up, right? What does that do to the consumer? We've published extensively here about, gas prices and the risk. Like we actually had a bunch of companies at our conference last week in Miami. We had 60 in total. O'Reilly was one of them. And, there's a lot of uncertainty, right? The key factors are, how long does the conflict last, right? We've seen this initial shock. We're really paying attention to what happens with consumer traffic trends and spending. So that is a risk if the consumer takes a leg down. But when you think about who are the more defensive businesses, auto parts is a relatively needs-based transaction. So I think they would be one that screens more defensively relative to some other discretionary purchases in retail.
Next hot pick is one I think a lot of people are familiar with, and that is Home Depot. What is it you like about this company right now?
Yeah, I think, if we start with the market backdrop, right? Like we've had a pullback in a lot of the housing exposed names within the last, month to 2 months. There was a lot of optimism coming into the year that we're going to start to see rates come down. I think you look at the opportunity here with the sell-off in this macro tape. This is your opportunity to lean into some of the better quality businesses that have a little bit more cyclical exposure. I put Home Depot right up there, right top of the list. You think about home improvement spending has a lot of pent-up demand for the next couple of years. It's been very difficult to call the exact timing, but we've been in this period where, housing turnover has been weak. People have been delaying some of the spending on the home. As you start to see housing turnover improve at some point in the next couple of years, Home Depot is really the best way to play that in our view. You've got the exposure to the DIY customer. You've got the exposure to the large pro. They're doing some acquisitions to kind of build their capabilities. So, I think you're definitely kind of defending the weakness here in a Home Depot if you've got a longer term time horizon.
It's so interesting. Like I'm assuming some of the key risks for Home Depot, like for this company, is in correlation really with the housing market and how the housing market is doing in Canada. Is that right?
Yeah, I mean, U.S. more importantly, but yes, rates matter for housing turnover, right? And what matters, housing turnover really drives people doing large project activity, and that's kitchens, baths, flooring. That's the area of the market that's been, weak. We've seen engagement get better in the home, but you really need, the unlock of kind of turnover for some of that project activity to happen. So, I think great business in terms of protecting profitability. If sales come in a bit weaker, there's no real concern about margins being at risk at a business like this. It's just top line environment could be a little bit weaker, but I think that's a buying opportunity in the longer term view of the business.
For sure. Okay, your last pick is Tractor Supply Company. What is it you like about this one?
Tractor's a unique one, and it's topical in the sense of oil prices going higher. If you're looking for retailers that tend to be a beneficiary from higher inflation, Tractor hits that. They sell some oil-based products, right? So think about lubricants and stuff of that nature. They have higher exposure to the domestic regions in the United States where you'd see oil production pick up, and maybe that helps the local economy. So that's a Texas and an Oklahoma. The other factor is, they really have a dependence upon commodity inflation. So think about corn, grain, they sell a lot of livestock feed. Those are leading indicators for kind of inflation in their business. The fact that oil has gone up tends to be a leader for commodity inflation as it relates to their business. So they look like a net beneficiary. Now, I think they're still a second derivative housing play. So you'd like to see housing turnover improve. They have exposure to the pet category, which feels like we're at a point that trend should start to improve in 2026. The last couple of years, sales have been weaker, but I think it's a good quality business. They've got great control over the operating margin from here, and it's another one where this weakness is probably a buying opportunity.
It seems as though, the retail sector as a whole has been pretty resilient to tariffs over the last year or so, absorbing those costs as much as they can too. We're starting maybe to see a shift in terms of consumer spending, like consumer pullback in the retail sector as a whole. I wonder if that concerns you at all for the sector moving forward.
The tariffs, we've been able to pass on some of the pricing, right? Mm-hmm. And we're probably at peak in terms of tariff pricing, second half of 25, really now, first half of 26. And largely speaking, we've been able to pass it on to the consumer. We haven't heard a lot of retailers have margin issues, right? I think the concern for retail and the consumer now, you have a prolonged conflict in Iran. Oil prices continue to stay high. What does that do to the health of the low-income consumer? What does it do to the propensity for, consumers to kind of spend on big ticket goods? It's a difficult environment right now, because if we get a resolution tomorrow and oil comes back down, it's a several week phenomenon that kind of goes away, and you start to see a recovery in terms of consumer confidence. But if it lasts longer, it is something to monitor for the health of the consumer.
For sure. Okay, we'll leave it there. Steven Zaccone, Senior Analyst in Equity Research at Citi. Appreciate your time and your insight. Thanks so much for joining us.
Thank you.
Coming up, we will tell you how GLP-1 weight loss drugs are reshaping the grocery store. That is coming up next. Welcome back. We are looking at the ways grocery stores are changing because of the increasing number of people that are using GLP-1 drugs for weight loss. So for more on the trend, ABC's Becky Worley filed this report.
Let's do a little grocery haul.
Back in the store to get another GLP-1 hyperfixation meal.
It's a grocery haul on a GLP-1.
As more Americans take GLP-1s, it's changing the way people eat and shop.
The baskets used to be bigger. Now they're a little bit smaller.
And behind the grocery shelves, planners like Yvette Decker of the Raley's grocery store chain are thinking hard about the products they stock.
GLP-1 medication users, I would say, is huge. It's not necessarily that you're shopping less, it's how these shoppers are shopping that's very different.
Approximately 1 in 8 Americans are using GLP-1 drugs. Decker says the amount of purchases they're seeing in their stores has decreased as people buy a little less food, but it's more about the makeup of that shopping cart.
Folks who are GLP-1 medication users are passionate about fresh. I am seeing higher protein, higher fiber, more green juices or green powders, more multivitamins, the different, like filling those nutrient gaps, more hydration and electrolytes.
And brands are trying to capitalize on those shifts. They're marketing to those GLP-1 consumers directly on the box.
For my GLP-1 shoppers, there's brands that are actually highlighting right here, GLP-1 friendly.
Says it right on the package.
Yeah.
Okay.
So a pizza and a pizza, this particular one is GLP-1 friendly, while this one is not.
But it's not just weight loss medications. It's also a change in messaging from government agencies. And it's all showing up in what's going on grocery shelves.
It seems like there's something on every aisle that's changed.
Down every aisle, and you'll notice it's on that eye level, which is that strike point, which is very important for the shopper.
The updated food pyramid has flipped the previous model, increasing the importance of produce, dairy, and protein.
There's a lot of conversation around fat and like the different types of fat, what's going on there, do we eat full-fat dairy? I'm seeing more of buying versus low-fat to full-fat dairies.
And Decker says there is a move away from ultra-processed food.
What in the past prior to the GLP-1 medication might have been in that basket?
Used to be a lot more so kind of sugary snacks and drinks in larger portion sizes. So it's smaller grab and go, smaller snacks, smaller sizes just in general, and less processed stuff.
Becky Worley, ABC News, Oakland, California.
And that wraps up this edition of The Open. Morning Markets is up next with Roger Peterson.